Well, President Trump voicing his frustration with the Fed again, even blaming the Fed for the market sell-off. Take a listen.
The markets are way up over what they were. It's a correction that I think is caused by the Federal Reserve with interest rates. I think the Fed is out of control. I think what they're doing is wrong. I think the Fed is far too stringent, and they're making a mistake, and it's not right.
Well, tell me what you really think, right? The president says he will not, though, fire Fed Chair Jerome Powell. Here with analysis on this, editor and publisher of the Gartman Letter, the man himself, Dennis Gartman, and president of Pacer ETFs, Sean O'Hara. Thank you both for being here. Dennis, let me begin with you. Okay, over-stringent, ridiculous. These are some of the comments that the president had for the Fed. What's your reaction to that?
I think that was absolutely untoward, ill-advised, and a very, very bad decision on the president's part. I hope that I'm clear. You don't take the Fed chairman, especially this Fed chairman, who is probably the most moderate and one of the decentest people you'd ever want to come across. He is not crazy. This is exactly what the Fed should be doing. They're doing exactly the right thing, and rates are still going to go quite a good deal higher. So I think the president made a very, very ill-advised decision last night by taking the Fed on. I think it was quite wrong.
But, Sean, you know, Mr. Powell has said, look, rates are far from neutral, I think he said in one of his most recent interviews, which kind of spooked the markets because, well, what is neutral? What's your response to how the president has characterized the actions of the Fed?
Well, he's been very unconventional the entire time he's been president. I don't know why anybody ever expects him to be anything other than what he really is. You can like it or dislike it, but that's just the way he's communicating with the public and expressing his opinions. You know, rates, I think the Fed has been fairly transparent in their terms as far as what they're expecting with regard to rate increases. And I think they'll probably continue in that vein. There's an underlying second piece of this, though, that doesn't get talked about that may be having as big an effect on what's going on, and that is that there's huge unwinding of their balance sheet at the same time. And so those two things together are, you know, things that have never really happened in history before. So we don't know what's really going to happen as it continues.
Dennis, I want to pick up on something you had in your notes. You said, look, we've been in a bear market, you believe. It began back in January, at least on the global platform, if you like.
Yes.
So should the Fed be raising rates if we're in a bear market?
Well, actually, the Fed is raising rates because the U.S. economy is doing quite well. They'll continue to raise rates. It is not atypical. It is not unusual for stock markets to go down even as economic activity continues to increase. Stocks bottom out long before economies turn higher. Stocks continue to rise long after or before the stocks turn down, long before the economies turn down. This is not unusual. This is highly expected, and we should not be surprised by this fact. So the Fed, I think, is taking a very moderate pace, 25 basis points here, 25 basis points there. We'll probably have 3, maybe 4 increases next year. It's going to take us a while to get back to a far more normal rate. Remember, I've been at this for almost 40 years. I can remember trading Fed funds at 20%. So the fact that we're here...
I know. I laugh, but I'm right there with you. I think the average on the 10-year has been 6% going back to 1958. Exactly. So let's keep perspective. Exactly. I think that's a very key word. Sean, let me bring you in. As we look forward to, I mentioned this in the last segment, look, the markets are forward-looking, and there are signs that perhaps there are concerns about next year. Earnings are going to be hard to compete with from what we've seen this year. Borrowing costs are going up. The global economy is showing signs of slowing down. China, look, someone said the other day, if we beat China, that's great, but China is the second biggest economy in the world and ultimately could end up hurting us. And in the meantime, we have the threat of tariffs. All of this as we look forward, how does that position us for 2019?
Well, I think that 2019, given all the things that you just mentioned, is going to be far more difficult than 2018. You know, there are opportunities for investors out there. You know, we run a portfolio. It's U.S. cash cows. We use free cash flow yield as the screen. It's 100 stocks. It has a very competitive dividend yield. It trades at less than 12 times earnings, and it generates a huge amount of free cash flow and has a free cash flow yield that's north of 8%. So as you look forward, if you're going to continue to invest in this market, what you want to be able to do is position yourself in equities and stocks in particular that have the ability to deal with those upcoming upstream input costs that might derail some other companies that might not be as flush with cash or as healthy or that are trading at multiples like they are. So like, you know, I was looking at our volume early today. The volume has been huge everywhere. By the way, this is also a pretty good indication that there is really liquidity in the market because like all kinds of ETFs are trading 1,000% of their average daily volume, and there's no real market disruption. But that's what I'd be looking for. Companies with solid free cash flow, high free cash flow yield, pays a competitive dividend, and are not priced at the current market level, traded at a discount so that you get a little bit of a buffer there.
We're already out of time. Dennis and Sean, thank you so much, gentlemen. We really appreciate your time
thank you.
Talking with us
Thanks,
today.
Ashley.
Thank you.